Hey, good morning, everyone, and happy Tuesday, and welcome to another edition of MTR. This episode is entitled The Yen is Everyone's Problem Now. As always, a quick disclaimer following podcast is for educational purposes only. This is not a solicitation to buy or sell commodity futures or options. The risk of trading securities, futures, and options can be substantial and may not be appropriate for all listeners. All right, everyone, we just wanted to touch a little bit upon the ongoing yen and carry trade dilemma that seems to be causing the market so much strife at this point in time. There are a lot of various dynamics at play here, and we're going to just take a look at, dig a little deeper into this. And given the sheer size of the global fiat system now, it's almost impossible to ignore. In fact, this has always been the global central bank's monetarist regime problem. The more you deny organic economic dynamics of pure supply and demand, the more you distort the reality for everyone else. Ultimately, what ends up happening is that the numbers grow so large due to years and years of bailing out fictitious nominal gains that you end up with perpetually propped up financial markets. You entice everyone in by continued asset price nominal inflation, but at the very real cost of real inflation to the average consumer. Now, this game can go on decade after decade, but ultimately the future catches up with you, and the present becomes a very real economic and financial nightmare for both the retail, labor, and consumer base, but at the commercial and central banking level as well. This is where we're at today. Evidence of this are these large FX moves that we are seeing right now, and in a globally interconnected financial system by which everyone is now tied systemically to one another. This volatility can wreak havoc very, very quickly. Basically, what Magna Libra is trying to say now is that you can no longer hide this charade of print to prosperity, that the money is becoming increasingly more worthless to the average consumer. They see it in their lack of affordability for their basic needs. For decades, central banks have distorted asset prices to the point now that the only way they continue to rise is if the central banks themselves grow their asset base. And you guys know that our very own Federal Reserve, or what we like to refer to as the FOMC, has done so at a rate of 9.8% annualized for the last 30 years. It's kind of strange for an entity that wants to say its target for inflation is 2%. Anyway, it's not only the FOMC, but every single global central bank has done the same thing. Yes, since 2020, they haven't grown. They've retreated a little bit in regards to the asset base, which you see down here in the chart, the major central bank total assets from Yardeni, which puts out some very good economic and financial data. So if you ever want to take a look at their site, you can go to yardeni.com and take a look at what they have. Yardeni Research is the name of the company. We've followed them for many years and they do a great job. And this is one of their charts here of the major central bank total assets. This is what you can do. Basically, what they do is print double digit trillions all at once, like they did post COVID, and spread it out through the economies. It buys you a few years, of course, but that's why we're seeing this downdraft here, is what you're seeing here coming off of this COVID stimulus, which we printed like we did back in 2008 with TARP down here all at once, and then had to continue to grow. All of this growth here in the central bank is just non-zero sum players propping up the markets and printing to their way to prosperity, which is what we had. And then you could see here we cut off in 2018, and then we had COVID again here, and another obviously financial problem, and they had to print again for COVID. Was COVID the excuse for this? Of course it was. And look at this big jump, and now we're just retreating a little bit back again here. But this is what they do. It buys a few years, and then fast forward to 2025, and you can see we're back on our way up, and those trillions didn't last long to support things. So now we're circling back up, which is you can see here. So take a look at this chart, guys, and analyze it. Go to Yardeni Research and take a look at all the other data that they have. Great resource there if you're looking for financial and economic data. The big question now becomes who's really better off because of all this printing? Well, we know that the 1% control 50% of all assets, or basically 10% control 90% of all assets. But where does that leave the other 90% who control virtually zero assets in a financially incentivized world? So we wanted to kind of solidify that thought that the central banks are indeed the ones that have, propped up everything thus far, but they've grown so large that now it's kind of becoming a negative feedback loop in a way where if they print more, we're going to see more inflation, and that's going to work against what they're actually trying to accomplish because the money is becoming that much more worthless, and the more that they print, it becomes even more worthless. So this is why we're seeing gold explode, metals explode, things like that, because the writing is on the wall here, guys, and so we just wanted to kind of point that out to you. And it all ties into this yen here as well, because it's part of this fiat construct and this levered carry game that they've been playing. And let's take a look at the yen chart here. You can see that it's up 13% just from the lows here to start the year. So pretty big move here out of the yen. And this is indeed very problematic, and it's most likely the result of the reversing of this yen carry trade. We feel this is going to continue and that the yen is about to put a whole world of hurt on this group that has reaped this virtually risk-free arbitrage for so long. In fact, when you look at the yen short term, it's hitting resistance here. You can see up here, right here, guys, hitting resistance area up on our chart, and you can click on the chart for a clearer picture as well. But you can see that that's the resistance level. Actually, let's go take a look real quick. We'll move over to the yen chart on here and just show you what we're kind of looking at here. So we're taking a look here at the yen. You can see this nice bounce off of 63 area. Now we're up to 71. So decent bounce here to start 2025. Same thing it did from July 24 all the way up here to September. And they did it. This was the resistance area back here in December of 23 as well. And here as well, kind of, back in 2023. So we're back to this level here. And it looks like, obviously that this is resistance level short term here for the yen. But we'll see. If you take a look at the longer term picture of this thing, obviously this is going to become very problematic above 72 area here in the yen. And for us here, it looks like obviously, this is down 50% here. And if you look back here since I think it's 2017 maybe. So where's the high? Oh, we're going back here a little bit further. Okay, so take a look at this chart here now, guys. So we're just backing this out here, going back to, 2011, I think was the high there in the yen. Yeah, 2011. So this could be very problematic here for these yen traders that are using this levered carry trade. And this could just be the beginning. So when we say this could be a major, major problem, and you're just seeing signs of it blowing up here now, it's could get systemically worse. So just wanted to point that out that this is just the beginning. This is not something that's going to go away anytime soon. And it's very problematic, the reversal out of this yen carry trade. We feel that this is going to continue and the yen's going to put a whole world of hurt, like we said here, on this virtually risk-free arbitrage that's been the case for so long. And, we looked at these charts here now. So you guys can get a better feel of kind of where this potentially is going to go and how much worse it's going to get. So those guys getting out now at the beginning, obviously it's worked well for them for quite some time, and now that trade is changing. So we got to be cognizant of and recognize that the carry trade is kind of winding down, and that those guys that are getting out now are causing this hiccup and problem that we're seeing systemically now. Well, imagine if this continues to get worse and worse in an accelerating fashion. Now you kind of see how big this can get. Because of this small move here of a 10 to 13% move, not that that's small, but generally if you look at the long scheme of things here, it is small, then things are blowing up off of this. What are they going to do when the thing goes up 25%? That's kind of what we need to be careful of here globally. It's become everyone's problem. So there's a couple of things we wanted to go over here in regards to the dynamics at play, and this yen strengthening is leading to these margin calls. So you guys can read through these. We're not going to read through all of them, but we put them down here in the show notes. You guys can just take a look at. Obviously, you know that you got to cover these short yen positions and buy those back, and it's forcing the yen even higher, and that's what's leading to this yen strengthening. But this is also leading to liquidity crunch, the treasuries to sell off as they need to raise cash and sell treasuries, which is generally what happens. And then this puts the Bank of Japan at a adverse position because they need to, obviously support exports and inflation, but tightening by these other central banks, which is the Federal Reserve keeping rates high, it does limit their ability to intervene effectively because, like we said, all these central banks are tied. So, even though the economies are different domestically, globally, all these central banks are generally affected by one another. So this becomes a big problem too, because domestic wise, they want different policies to be enacted, but globally the central banks work in coordinated fashion. So what might be good for one country is not going to be good for another. So this yen strengthening is going to be very problematic for the BOJ's weak yen policy. So we're going to, continue to see these global central banks battle it out here, and kind of see. And from our purview, it seems to be that the Federal Reserve is keeping rates high and will do so for the short term. But ultimately, they will have to recycle back down. And you guys know we think rates are going to go lower eventually. But all this volatility right now is leading to these yields to be elevated. So we do expect that to come off over time. But we put in the show notes a bunch of details about how this affects, the higher yen affects like a company like Toyota, who sells a lot in America, and how it's going to affect their revenues because the stronger repatriation of the from the dollar revenues to the yen is going to lead to their loss and operating profit. We have this down here, the Toyota's FX sensitivity. The 50 billion operating profit per $1 yen weakening implies 50 billion yen per $1 strengthening in regards to how the dollar yen conversion of the sensitivity. So we can use that in order to see how much the estimated FX loss there is. And a 20% rise in the yen will lead to a $10.4 billion loss, not yen, but dollar operating profit hit. So this is a big deal, guys, to companies like Toyota or Samsung or any of these Japanese companies. So we got to keep, Sony, Panasonic, and it will hurt the Japanese, the Nikkei index as well by lower earnings equals lower equity prices. So this is a very big problem, and it's something that's super complicated. And it's if it's not, done right in regards to alleviating this slowly and kind of methodically, this could lead to a massive volatility spike across the world. And we think this is, like we said, this is everyone's problem. This is not just Japan's problem. This has become everyone's problem because everyone's systemically tied now. So we know that the BOJ is going to have their work cut out for them here. They hate the strong yen because it kills exports, profits, and inflation. And we don't, from where do they go from here? It's going to be interesting to see how they solve this problem. Because we think they're eventually going to have to come in and intervene and cap their interest rates. We know that they're raising rates a little bit off of their policy rate. You can see here has gone up, but ultimately they're going to have to figure this out to whether or not they can, Japan's got a lot of FX reserves and a lot of assets. I think they're the third largest asset holder in the world. So they do have, a lot of leeway here in regards to what they can do. Just their execution of how they do it is going to be a bigger deal than what people, obviously think this is such a, simple thing like this is just going to go away, the yen will stabilize, but we don't think that's going to be the case. We think the writing on the wall is already here, and then just a little bit of volatility, you can see how it could cause systemic issues here. So this is, going to be a full-blown stress test for the entire global financial system and the reckless money printing experiment of the last 2 decades. So JGB yields are exploding despite a stronger yen, defying all traditional logic because the world is now trapped in a feedback loop of rising rates, debt addiction, and policy desperation. Japan's debt monster is just the first domino. If the BOJ loses control, the shockwaves won't stop in Tokyo. They'll rip through FX markets, blow up carry trades, and force every central bank to choose between financial stability and inflation. This is bigger than most realize, like we said, and the stakes couldn't be higher. So it's important, guys. Don't let anybody sugarcoat this. That it's just we know how esoteric this subject is with everybody, including even some sophisticated investors. But you can see here and go through kind of like what we put down here in the show notes in regards to Toyota's FX losses, in regards to their sensitivity to every dollar strengthening of like the yen. So it'll be interesting to see. Kind of how this transpires. So let's take a look now. We'll go through, take a look at the charts here. The trading day is open here now. Let's take a look at the triple Qs. We like to, so moving on from that yen, let's go into some technical charts here. We just wanted to point a few of those things out there to you guys so you guys are aware and you can do your own digging and research on this stuff because this is important subject matter that we do believe is going to affect everybody here eventually. But so let's take a look at the technical charts here. So we're going to look at the weeklies first. We're going to take a look at the triple Qs here. We can obviously see that 432 is a big level. Late day buyer yesterday in most of the equities there. You can see them come in buying call structures and pushing the market higher late in the day, the last half hour, hour or so. And it's led to a higher opening today. Triple Qs are up almost 2% here this morning. but this is an expected off of Fibonacci 382 retrace here, and we'll expect 455 to be our resistance here again. Will they get that high today? Probably not, but ultimately that would be our target and resell zone there. But for now, the base is 432. Triple Qs are going to be in a bullish uh, pattern here to start today and this week. As long as they're above this 432 level. If we start to trade below here, we get to this 425 area where we'll really think we have big support. That's where we'll see continue the battle to go on down here. But for now, the triple Qs seem pretty well supported. Let's go over to the 10-year. We'll just go down the line here of our list here, and we'll take a look at the 10-year. Obviously, we've had this 437 level here for so long. Just keeps battling around there. We're at there again. Yeah, as we said, this yen carry trade is going to keep yields in the U.S. Treasury Department higher as well for now, until things start to systemically really blow up. Then yields will come down, and U.S. Treasuries will act once again as a safe haven, even though everyone's saying that they're not. Ultimately, UST bills and everything in that nature are still the safe haven, despite a lot of rhetoric out there that's saying the U.S. Treasury is losing its safe haven status. We don't believe so. This higher yields is more of a function of what's going on between the global central banks and the battle between who needs to raise cash quickly and who has the sustaining power. So 437 continues, guys, to be our line in the sand here, and it seems like it's magnet for the market right now. But ultimately, we'll expect this downward trend channel to dominate and for the 10-year to get back into here. But that doesn't mean we're not going to get bouts of popping up higher, possibly to the 450, 460 area. But for now, 437 seems to be a good magnet, and you guys know we've had that number there for quite some time. Let's move over to the S&P 500 futures. Once again, got down to our 51.25 area here. This is our support area, and now we're bouncing back. 53.38 is the target area on the upside, kind of like that triple Q 455 area. We'll expect the S&P 500 futures to have resistance up here at 53.40 area. So, like I said, whether they get there today, I don't know. They're already up 1.3% today. So we'll see what happens, but this is going to be our range of expected buy and sell this week so far. S&P 500 futures there, and let's take a look at the Nasdaq. Same thing, 17,650, big level there in the Nasdaq, supported there now. Let me clear some of this stuff out here. Let me get rid of this one. And this is going to put us back into the 19,000 will be the focus again. Like I said, it also lines up with that 455 triple Qs. And so the bulls are in control here. It seems like right now, this is that 618 longer term retrace at 18,000 level. And so let's just, the bulls can be in control above this 18,000 level. It gets a little skittish below. But ultimately, 18,000 and 19,000 seems to be our dedicated longer term at least, sell area, 19,000 area. So we'll see if we can get that push up there this week. We'll most likely see sellers there, but we're not sure if they can get that high. Today, obviously, that would be a big move, but ultimately, that's where we expect to see sellers, and we'll see buyers down here at 17,650 area for now. So this 17,650 to 19,000 seems to be kind of our decent expected range for the week. So take a look and see what you guys think. But ultimately, these are your volatility levels of risk. So we just wanted to point that out to you. Let's take a look at that Nikkei real quick. We know 34,000 is pretty key. We're above it, but like we said, if this yen carry trade continues to blow up, this is going to start to eat into the Japanese corporate profits. This is going to lead to lower profits here, and which will be reflected in a lower Nikkei. But ultimately, 30,545 here is where we'd like to see a breakdown. If a long-term major top is in, they're going to have to break out of this upward trend channel, and 30,545 for the Nikkei would be that level that we would like to watch. But for now, the bulls are in control above 34,000. That's kind of like our hard deck there for the bull bear. Bulls are in control here for now, so we could see this thing trend back up here to the 38,000 level or so. So that's for the Nikkei. Let's take a look at both the euro. We already looked at the yen, so let's take a look at the euro. It's already making its way up here. 117.73 is our target here now. So we would not get in front of the euro here. We would not be short this euro here. It's strong above 113 area. Obviously, they tried to hold it there for a little bit, but did not work. So everyone's got stopped out here on their first sale, the 618 fibs. most likely technical sellers bailed here, and now we're seeing possibly renewed buying for this push to set 117.73, 118 area, which we do expect the euro to get to. That'll be our initial target before we start to see any real resistance selling, and ultimately longer term, obviously if that level gives way, then we're talking about a move up to 125, 124, 125 area. So euro is strong here. We would not get in the way of that trade as well. The yen, we could probably expect sellers here initially to be resistance here at 72 area, but ultimately we do believe this thing's putting in a nice, look at this, it's almost like a quadruple bottom here. One, two, three, four loops here, and a breakout above here would be very interesting to see. What kind of chaos this is going to cause. But for now, let's see if this area holds this week. We get a weekly close above, like say 72, then we could see a nice, decent, chunky move straight up here off of that move. If we do get a close above there. Crude oil, not much there. You guys know we're stuck between this 54.67 area and honestly, this is a awesome doji bottom here. So the bulls are in control here of crude. So we also would not be selling crude oil here. Be better buyers actually with stops below 60. It seems like is the right play there. But crude oil seems to be taken in, working off the oversold conditions and a little bit of a bullish pattern there. Let's move over to the metals. Gold super strong, like we said. This one we don't even have any resistance for this. Maybe 7,500 bucks. I don't know. Ultimately, it's just got to let this play out. You trail up stops. If you're long, you continue to be long. You do not sell this thing and try to be a hero. They tried it here at the 3,100 level and it just failed epically. And now 3,205 is kind of where our area of support would be to keep the bull theme intact. So above 3,200 bucks, that we expect longs to continue. If we start to trade below there, then a potential top might be forming, but trailing stops should be there around 3,200 bucks now. Same thing, silver's going to have to play some catch up here, which it did. Nice big downdraft, probably liquidity sale there out of silver, raising some money, but then real buyers coming in here again. And this thing can get real bullish here. We're above this level here. This thing's going to move up. We should probably move this up a little bit here, uh, close to probably just the 30 buck mark. But this would kind of be our support. We needed to get above 35.50 here to kind of break out of this area for silver. But bullish here on silver above $30 as well. So just like gold above 3,200, $30 in silver is kind of like our same area there. So that's kind of what we're seeing there in regards to the markets. We don't know if, the metals, like we said, we don't really have very many resistance points there. This is kind of a transition, we feel, a switch from kind of this fiat global central bank system into kind of more of a hard money, people going into gold and silver for protection. And this could be the future of the new monetary system, which we do think is going to have to transpire sooner rather than later. And we believe this kind of disruption could lead to a host of problems across the globe. So we're not taking this lightly, guys. This move, we think the first salvo has been set here in regards to the selling in the equity markets. We think the overvaluedness of this fiat nominal price increase is evident. And people look at this. What is this drawdown here from the triple Qs? Let me just see real quick what this is here from the top to the most recent low. So that was about 25% drop. This could just be the beginning. Unless the central banks can continue to print and find a way to support nominal asset prices, we feel that the top is in, and that sellers could be dominating here for the rest of the year or even longer. And that with the tariff situation going on, with the way the Trump administration is going to push for a pro-American first policy, this is also exacerbating these FX moves and causing uncertainty across the globe. And this generally does not bode well for our global economies, this kind of uncertainty. So we don't see, we're not bullish here on equities, guys. Yeah, we know it's pulled back, and we know you've been lulled to sleep to just buy the dips, buy the dips, buy the dips, but this is something much larger. This is something much larger going on behind the scenes here, and the readjustment is going to be not going to happen overnight. If you haven't realized profits, and we always see this all the time, people are like, oh, the market's lost trillions of dollars. It hasn't lost anything, guys. The market doesn't gain or lose. It's up to you to realize unrealized gains. If you don't realize the unrealized gains, you've lost nothing but the opportunity to do so. Don't fall for that. There's better times to be had ahead, better areas to buy. It doesn't mean like we've come back 15 to 20% that it's a good buy. Nothing tells me that this is a good buy here. Nothing. Everything telling me that this you should be selling here. And I could be wrong, but I'm going to step out and say I'm not going to be wrong unless this QQQ gets back above here and we start to break above 480. But for now, the writing's on the wall. If you didn't realize your profits by now, then you only have yourself to blame because there's better areas ahead to find value. And when Warren Buffett's continuing to raise cash and he's been selling for 2 years now since here, Warren Buffett's been selling out of this market since basically right here in January of 23. This is the triple Qs. I'm not talking about selling out of the triple Qs. Talking about selling out of his positions and raising cash. He's been doing so for years, 2 years now. And people will say, well, he's not, obviously he's the best investor of our time, I think. And if when he's selling, even though this market's rising, he's doing the right and prudent thing that he sees in regards to where he sees value. He doesn't see value here anywhere. And so he's going to sell. And he's not selling for today, tomorrow, or next year. He's selling to find value over the next decade. And from what Warren Buffett's telling me, he doesn't see any value here. And he might not see any value here for years, not knowing how many years he actually has left. But the writing's on the wall. And when Warren Buffett's raising that kind of cash, you guys should listen because he knows this stuff better than anybody. And so when you look at this and we see a 20% drawback and think that that's value there because of that, that's what I call a rookie trader, a rookie investor that doesn't understand the longer term things. Now, I'm not talking about short term algo traders in and out. I'm talking about longer term investors that say, okay, we've pulled back. Maybe I'll come in and buy here. Well, you could do that, but I would do so on a percentage basis. So basically, what that means is if I'm going to allocate, let's say, $1,000 to buy in this market over some point in time, well, maybe I buy $300 here. Maybe I buy $300 down at 380 in the QQQs. Maybe I buy another 300 at $300 down here. Okay, that's what a prudent investing scenario looks like. But to say just blindly that this is worth value because it's fallen 20% is stupid. So don't do it. Anyways, that's it, guys. Take a look at the show notes. A lot of stuff in there about this yen carry trade, how it affects companies like Toyota and Panasonic and Samsung, and how it affects the BOJ and what they're trying to do, and what all these central banks have been trying to do. But they've created this massive monster. So we're not sure that it's going to end the way that they think it will because the amount of sheer capital at risk here is massive. All right, so that's it, guys. Hopefully, hit that subscribe button, and that's going to be it for now. We have the settlement sheet and all that will be there for the subscribers' data that we send out. And hopefully, you guys do hit the subscribe button and get this daily data because we think it does say a lot of how we look at things and how we can improve and enhance your thought process in regards to how you look at financial markets in general. So we know you're going to get something out of it. We think it's priced fairly, and we hope you hit that subscribe button, and then you'll get take a look at some of the content that we put out in regards to daily settlement sheets, which you can see, kind of take a peek there and see. But we're going to save that content for our subscribers because we owe it to them. And so think about subscribing, and hope you guys have a great rest of your day. If you can support our work, please do so. If not, at least just give us a share, spread the word. Hopefully, we get more people out there trying to understand what's going on here because there's a lot behind the scenes that we think are yet to be understood by the average investor. But we're hopefully going to change that. All right, guys. Cheers.